morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host, and we have a caller who I've forgotten.
Oh my goodness.
I know. Good morning. Welcome to the Retirement Report.
Yeah, good morning. How you doing?
Very good, thank you. How can we help this morning?
I'm kind of hoarse because I've been to the doctor yesterday. Now I got a friend that sold some property. I heard you talking at the beginning of the thing. I think she sold, say, 80 or 90,000 she got. She wouldn't have sold it, but her husband had been sick and had to go into nursing home.
Okay.
But she sold it for that. So say she sold it for 80 or 90. I think 90. I'm not sure. But then he passed away. She wouldn't have sold it, but she sold 20 acres or 25 acres. But she kept 5 with the house and stuff, still making payments on it. She was wanting to know, reckon, if she'd have to pay taxes or anything on that 80 or 90 that she sold.
Well, you got some different things that are going on. So how long was her husband in the nursing home?
Oh, probably wasn't over about a month and a half. They sent him from Dixon to Murfreesboro to a place that they carried him down there, and she didn't even know it, and kept him a week and a half there. Then she finally found a nursing home to get him into, but I don't know. He died. He didn't die there, but she went to see him like on a Monday evening. She had tires on the car, and they should have sent him over to the hospital earlier. And he died the next day. They got in the hospital on Monday night. The next day he passed away that evening.
Does she plan to sell the house?
No, I don't think so. She's wanting to keep it. She's still making payments on it.
Okay.
Getting 5 acres.
Okay. She's going to have a couple, like Hank was saying. There may be some medical expenses that she'll have that are higher that might help her to meet the standard deduction, because she will be filing married still because he was alive, or, you know, he was during the year. So the biggest thing is if she made a profit of 80,000. Now the question is, did she make a profit of 80, or did she sell it for 80?
I don't know what the land. I don't know what they paid for it, or he had paid for it before. I have no idea.
Right.
I'd
So
say
that's
25 or 30,000.
She's going to need to get a cost basis, because this sounds like it was their primary residence.
Yes.
But since she didn't sell the house with it, so unfortunately she's not going to get the exclusion,
right,
unless she sells it within 2 years of his passing, which doesn't sound like that's a plan. So it sounds like she will have some possible capital gains. If there's a cost basis and it keeps them under 77,000 their total
right,
income, she could be in the 0% capital gains.
Exactly.
So she really needs to talk to her tax person just to get some advice on what's the best way to make sure she has a little money set aside. If she does owe some, it would be 15%, but not on the whole price.
Yeah, so depending on what they paid for it, what if any monies went back in, as far as, like, I don't know, if they did any kind of property improvements, adding a fence or stuff like that as an example.
Okay.
Offset with medical.
I watch your show a lot when I get up, and I had to go to the doctor yesterday, and I can't always bring you that call with sinus infection. But
Gotcha.
I thank you so much.
Thank you for
feel
listening.
better. Take care.
All right, bye-bye.
Bye-bye. This is one of the areas when it comes to what we're just talking about. If you can split gains up, if you can sell off, if you were selling property as an example, and you could split that sale up over a couple of years, there's a lot of different strategies that can be employed to help reduce down that gain. Thinking in terms, again, if you've got property improvements, that can be another offset. And this is one of those areas that ran into recently, costs of a sale.
Yes.
So how you delineate those things that are considered costs of sale. See, if you think in terms of what's going on with capital gains or with sell a property as an example, there are things that you can add to your basis. In other words, what you paid for the property and what you added in terms of improvements, that's improving from the bottom up. And this is real important, because in this situation, if you're improving the basis, but you haven't sold the whole thing, then that basis is probably for the most part staying. You're not getting the advantage. So cost of sale, though, where you maybe have, of course, real estate expenses, marketing for that, maybe some
she would have
things
had
that were
some
necessary.
things like that, but you have to be really careful, because most of the improvements are often tied to the house.
Right.
Because most of the time, so I mean, even like a fence, if it's 30 years old because they've lived there for a long time, you're probably not going to have the receipt, no idea what the cost was that really was done. Right. I mean, I'm just saying. So you really need, and that's one of the things people often, when you're really working with your home or your property, having a box of receipts of all the things you've done to improve your home, because repairing a wall is not an improvement. Putting a new roof on your house is an improvement. So knowing which ones to save and which ones not, but it's really important, like he says, if you can come up with what you've actually put into it, because in this case, if someone's owned the property for 30 years, they may have paid $1,000 an acre.
Right.
32 for the entire property, built the home themselves. I mean, we've got a lot of clients. It's very hard to get back to that cost basis. So, and it sounded like she was more reacting to a situation than really thinking about what's this really going to cost me, because she was trying to take care of a husband. But she needs to get a little tax advice now that she might be able to focus on it to make sure it's good.
Yeah, and it's the same. If you're dealing with a situation where you're thinking, and it's not just with regard to real estate in these examples that we've been using,
everything.
but yeah, if you've got highly appreciated stock or mutual funds, an investment account, and you're looking to prune that a little bit in terms of taking some profits and kind of protecting what you've made, making sure that you've got how to minimize taxes, or maybe it's a time to change investment strategies depending on what you're in. Maybe you've had a nice run on something, but you're thinking it's hit its limit and you're wanting to see how the best way to get out of it, to preserve your profits, protect your principal, and at the same time reduce your taxes. So it's all about, this is one of the things when it comes to planning, is making sure, if you know in advance, and ideally you're thinking of doing these things, this is the time to sit down with someone where we can do the projections for you and show you, if you do it this way, this is what's going to happen.
Exactly.
And maybe offer up some suggestions of ways that you can help minimize that, other strategies you can employ. It's understanding that ahead of time. Once you've done, kind of pull the trigger, like in this situation with the caller, and once it's sold, well, we'll try to do everything we can to help you minimize the tax on that profit. But having done advance, may have come up with some strategies that could have been employed that may have reduced it even further. So again, tax planning is so important. And when you're looking to do a major change in some way, like Roth IRAs, this is another one, by the way. The new tax law is doing away with recharacterization of Roths. So understanding how this one works. If you're thinking of doing a Roth IRA conversion, and we've used that for many years. An example would be if we're looking at future taxation, and you're going to have required minimum distributions when you hit 70.5, let's say, and those required minimum distributions maybe push you into a higher bracket, or maybe two higher brackets as an example. Well, one of the things by employing strategies now before you reach 70.5 to do Roth conversions can minimize the required minimum distribution, since you don't have to take those out of a Roth, for instance, and thus reduce the taxation overall. So long term, it could paying what the tax would be today, maybe less than what it might push you up into tomorrow. Well, here's one of the things that goes with that. Roth conversions used to allow us, if we, this year and prior years, if we did a Roth conversion and then we determined, maybe that wasn't such a good idea, maybe your income was a lot higher than you thought it was going to be, or some other thing came into play, we could recharacterize. We could turn it back into a traditional IRA, or some amount of it, so that we could keep it in the right limits. This is where tax planning is going to be so much more important now going forward, because that the new tax law has done away with the ability to recharacterize. So basically, we're going to have to be even more careful, allow even maybe a little more cushion to make sure we're not going to have to worry going forward, since we won't be able to do that do-over.
I didn't know that. See, there's all kinds of little interesting things that are kind of sneaking in. Another one really quick, I think, is the casualty loss. Many times people will have a home loss due to flooding, or some area that is not considered a natural disaster. That is going to be coming off the books. So anytime you have a major loss, unless it is a federally declared, and it has to be a federally, so not even a state declared, but a federally declared disaster area before you can actually claim it. So like our flood in 2010 would have qualified, but if a tree falls on your roof and smashes everything, and the water floods your inside of your house, and you don't get full reimbursement, guess what? Not going to be covered any longer.
Not deductible. This is one of the things too, the repeal of the individual mandate. This is one that's been in the news quite a bit. So
be prepared.
There you go. This is the big change. Now, this is not real important.
When does it come
into
effect?
Yeah, it does not go into effect until
2019.
There we go. So for this year and for next year,
17 and 18, it's still out there. So that is probably the number one question coming through my office, because everyone heard that Trump had, signed a letter saying he was repealing it. So everyone thought, I don't have to. And right now is the time when people are getting, I guess you have to re-sign to get into the marketplace or whatever exchange. Long story short, if you didn't have it for 17, you're going to pay a penalty. If you don't have it for 18, you're going to pay a penalty. And the penalty at this moment, I think I looked it up, was like $2,085 maximum. that's for the per person, and that's based on the 2.5. The minimum is $695 per an adult, and roughly $348 per child.
Wow.
So it can be very. I mean, my opinion, it's a pretty hefty penalty, but
Yeah,
in
that's a lot.
comparison to what you pay for health insurance, many people are saying it still doesn't compete with $8,000 or $9,000 or $10,000 that they might have had to pay in health insurance.
Yeah. We're going to go to the phones again, and this is Linda. Linda, welcome to the Retirement Report.
Hi, good morning.
Good morning.
I have a couple of questions
Okay.
regarding what one would owe. For example, I sold a house this year, 2017,
Mm-hmm.
and I received about $60,000, but I did put money into getting the house ready to sell, say maybe
Sure.
$2,000, $3,000, and also I paid about $11,000 to
Real estate.
real estate, and I also had like a what is it?
A line of credit
A
or
lien
mortgage.
on it, which was about $6,000.
Okay.
So I want to know how that, if I'd have to pay any taxes on that, and also I have made some small investments this year in the market, and I want to know, I haven't taken anything out, nor will I, where I have to pay any taxes on those. Okay, thank you.
Is this your personal residence?
I'm sorry.
Was this
Your
a
primary.
personal residence, or is this a place?
Yeah, it was personal.
Okay, so this is your residence. Okay, good news coming.
Yes. So I can give you half the answer, and I'm going to shoot the ball over to Hank on the investment side, because I know there'll be some additional questions he'll have to ask on that one. If it was your primary residence, you lived in it for more than 2 out of the last 5 years, there will be 0 tax due.
Okay.
So that's the good news. Hank, give her the bad news. No.
So, well, now you
May
mentioned
not.
about selling some investments off.
No, she just invested.
Well, first of all, I want to know about the cost that I incurred in selling the home,
No,
as
the-
far as upkeep. I mean, repairs. I think I spent $2,000 or $3,000,
Right.
and also I paid about $11,000 in real estate, costs, and there was a $6,000 lien that I had to clear.
Right, so none of that will be a tax deduction, but you won't pay gains on any, you cannot take a loss on your primary residence, I guess is what I'm going to say. So if it's your primary residence, there is no loss, but if there was a gain, there's no tax up to, for a single individual, $250, or married couple, $500, but you cannot claim any losses.
Okay, thank you. Okay, the investment side, yes. I make small investments, but I'm not going to take anything out of it this year.
Okay, and is it a non-qualified
Dividends?
account or an IRA or?
No, it's my individual. I don't have an RA or 401 or any of that, so I set up something for myself.
Gotcha.
Dividends.
So yeah, if you're going to have, you may have some interest and dividends that come out with, even if you don't take money out, and you're reinvesting, in other words, the interest, dividends, that kind of thing, then you still may, depending on what part in the year, you may get 1099 for some amount there that'll be taxable, but depending on how it's invested and the kind of strategies you're employing as to what that might look like. There are tax efficient portfolios that can help minimize that, and then but for the most part, if you've got mutual funds or individual bonds, that kind of thing, that are spinning off interest and dividends, that's where you might get some tax.
So the IRS will let me know if I have to.
Well, what'll happen is you'll get a 1099 from, if you're
The
through
investment.
a brokerage or wherever the investment is, you'll get a 1099 at the beginning of the year that'll, show you what that interest and dividend. So when you file your taxes, you just make sure your tax person has that, to be listed in your tax return.
And one more thing, I'm on disability, so my income is below $20,000. Will
Right.
what bracket will I be in?
Well, theoretically, if you're on disability, and if it's Social Security disability and you have no other income than what you've just told us, you won't even be required to file taxes. But you would be, because you'd be basically in the zero, because disability in itself is not taxable unless you have other earnings.
Well, I usually itemize, though, because of the charitable giving that I do every year and such. So.
Do you have other income other than disability?
No, I do not.
Okay.
But I have always itemized because of that charitable giving and things.
I'm going to tell you, I don't know who your tax person is, and obviously you can always file taxes, but you've been paying 0 tax every year because the itemizing doesn't kick in. you only itemize or file taxes if there is a physical income source and disability in itself. Are you married with someone making money?
I'm single.
No. All right.
Are
You might
paying
want to
any taxes
reevaluate.
in? Are there any prepay of taxes of some sort?
Do you get a refund every year? Or you just pay zero?
But sometimes I get a very small one because of some of the provisions, I can't remember the names, but some of the credits they allow, will result sometimes in a very
unless
small.
you have earnings, you really don't qualify for any credits, and therefore, I'm just saying, you might want to talk to your unless you're doing it yourself. If you've got someone that's helping you, like VITA, or someone that's helping you do taxes, they should be telling you that under what you're telling me, you are not required to file tax returns, just to let you know, okay?
I see. Okay.
Thanks.
Thanks so
Linda.
much.
All right, we're going to have to take a quick break. Join us here. We'll be right back on the Retirement Report.